Hi, Damien here from Integrity, and today we're going to talk about the eternal question: what's better, shares or property? We're going to talk about three things. One, we're going to talk about the historical performance of both. Two, we're going to talk about the effect that leverage has on both. And three, we're going to run through some examples to see which gets a better result. Okay, most banks will only let you leverage into shares about 60% of the value of the portfolio. So they'll let you borrow 60% of the money and put it in shares. And interestingly enough though, they won't let you secure that against the shares necessarily. They'll want to secure it against the property. Ironic, isn't it? However, on property, banks will lend you up to 95, in some cases this is 97%. Of the value of the property, they will lend you the money. Why do you think that's so? I'll tell you why it's so, because the banks know what property investors know, is that property is one of the safest investments there is. Now let's look at what happens though when the leverage effect is applied to borrowing money and getting property. First point, what's better? Historically, we know that shares have actually outperformed property dollar for dollar, i.e. if you pay cash for your property and cash for your shares, shares are going to outperform property by about 1% historically in Australia. But of course, nobody buys property without leverage, and these people who will try and sell you shares, stockbrokers, financial planners, they will always forget to mention that leverage gets you a massive result. So now let's talk about leverage. Okay, so let's say we've got $100,000 and that $100,000 we're trying to decide whether we put on the share market or whether we buy property. So let's look firstly if we put on the share market. Now, if we got 7% return on our $100,000 for 10 years, compounding every year, we would end up with $196,000. Now that's a pretty good result, almost doubled over 10 years. However, what happens when we get into property? So let's look at first what a conservative property investor would do, and let's put down a 20% deposit on a $400,000 property. So we're going to put down 80 grand and we're going to use 20 grand to pay our stamp duty and costs, and we're going to own a $400,000 property. Now we know historically in Australia property values have on average doubled every 10 years. Now in fact, in the 70s, it quadrupled. And in Brisbane, for example, went from about 8,500 to 36,000. Hard to believe, I know. In the 80s, it actually tripled. In Brisbane, again, was 36,000 and went to 100,000. In the 90s, it doubled, and last decade, it doubled again. So the worst case scenario in the last 40 years is that your property will double in value in 10 years in a capital city. So let's apply that circumstance now to our leveraged property investment. We've spent our 100,000, 80 grand deposit, 20 grand for costs. We now own a $400,000 property and we have a $320,000 mortgage. So 10 years later, that property is now doubled in value. It's now worth $800,000 and it's got the worst case scenario with the debt is it's $320,000 still, no change. We had an interest only loan the whole time and we didn't pay a red cent off the loan. Now when I went to school, 800,000 minus 320,000 equaled $480,000 net. Now remember, in our first example with shares, we only ended up with 196,000. So already the conservative property investor who leverages their way into a property at 80% is more than twice as better off. Now let's then look though at what an aggressive property investor would do. Now an aggressive property investor wouldn't just settle for one property with their 100,000, they'd buy two. And so let's say they go and buy two $400,000 properties with 95% mortgages on them. Very aggressive strategy, worth noting that, but it gets a fantastic result. So at the start of our 10 years, we own $800,000 worth of property. We've got $380,000 loans on each property, or $760,000 total. But at the end of 10 years, our portfolio has now doubled in value. Each property is worth $800,000, and that's a total of $1.6 million. Now, worst case scenario again for the debt is that we haven't paid off a red cent. We've got $760,000 of debt still sitting there. Now, when I went to school, 1.6 million minus $760,000 was $840,000. Remember in the first example, buying shares gets us doubles our money. Well, highly leveraged property is going to get us more than 8 times our money in the same period of time. Smart property investors know the more property you buy, the better. The real art to property is making sure that it pays for itself so you can hold it for that 10 years. And we'll talk about that in future blog videos. Okay, thanks for joining us today. And remember, if you need help with property investment, if you haven't been taught about property investment and you need some coaching and education, then go to propertyinvestmentmentor.com.au and you'll find all about how we can help you there. If you're okay with your education and you just want a really good property that's been well researched, is in a great location, go to integrityproperty.com.au. That's exactly what we do there. Thanks for your time, and I'll see you next time. Bye.